This lecture will step you through using the corporate valuation model basically as a review, and it will also develop the adjusted present value model, which is an alternative to the corporate valuation model. Now, the corporate valuation model is best used when the company's capital structure is going to remain fixed. That is, the percentage of debt and the percentage of equity, market value percentages, are expected to remain constant or at least pretty close to constant over the projection period and also in the future. But in many interesting cases, that's not going to happen. And if there is a major recapitalization, that means the percentage of debt and the percentage of equity are going to change significantly. And in that case, the corporate valuation model is not appropriate and the adjusted present value must be used. Now, the reason for this is there are lots of technical reasons, but the basic reason is that the corporate valuation model incorporates the value of the interest tax shields, meaning for every dollar of interest that the company pays, it saves in today's tax environment 21 or 25 cents of tax payments. And that interest tax shield is incorporated into the weighted average cost of capital. And we're assuming that the weighted average cost of capital remains fixed. In the APV model, however, what we do is we incorporate the tax shield by calculating it explicitly and discounting it separately from the free cash flows. So we have two pieces in the APV model. We have present value of free cash flows and we have present values of tax shields. And doing it this way allows us to have very general relationships between tax shields and free cash flows, and they don't have to be fixed through the weight on equity and the weight on debt. So the way this is going to work is I'm going to have you pause this playback in a second and open the accompanying Excel spreadsheet, which has some projected financial statements. What we'll do is I will work through these exercises for one company. You'll pause the playback and work through it with your company, and then you'll restart. So when I ask you to, in a minute, I'm going to ask you to pause the playback and create the portions of the model that I create. So right now, pause the playback and download the Excel exercises and open them up. Now, welcome back. I hope you've downloaded the Excel spreadsheet. And what we're going to do is we're going to calculate some free cash flows. Both the corporate valuation model and the APV model are based on free cash flows. So the first step is going to have to be to calculate free cash flows. Now, the definition of free cash flow, and this is a review again, is that free cash flow is the cash that's available for distribution to all of the firm's investors, and that would be stockholders and bondholders, and if they happen to be preferred stock, then it would be preferred stockholders too. And those cash flows that are distributed to investors consist of dividends and stock repurchases. Those are cash flows that go to the shareholders. After-tax interest payments and principal payments go to the debt holders, and then you might very well park some of that money temporarily, and that shows up as an increase in short-term investments, and it might be used later. So stockholders, bondholders, and then you might very well park some of it. But that's not a very useful definition for calculating free cash flow. We need a value for it. And so instead, the accounting definition of free cash flow, which is equivalent to the one on the previous slide, is that free cash flow is net operating profit, which is also called EBIT times 1 minus the tax rate, net operating profit minus the investment in total operating capital. We'll do this calculation in just a minute, and the definition of total operating capital is on this next slide. But think of it intuitively, NOPAT, net operating profit after taxes, is hopefully this big old pool of money that the firm generates from its operations. Out of that big old pool of money the firm generates, it must pay some money to reinvest in the company in order to support any type of operation. So it may have to buy new equipment, new plant and equipment. It may have to make all sorts of investments. And that investment that's required in any given year gets subtracted off from net operating profit after taxes. Now, the total operating capital in any given year is defined to be operating assets minus operating liabilities. Operating assets are basically, for our purposes, everything that's an asset except for except for basically short-term investments. It's all assets except for non-operating assets, and for most companies that would constitute short-term investments. So all total assets minus short-term investments. Operating liabilities, on the other hand, are only short-term, so they're only inside the current liabilities section, and they consist of accounts payable, accruals, and then sometimes some other operating short-term liabilities. Basically, it's everything that is a current liability except for anything that looks like short-term debt. So that would be except for things labeled as short-term debt, things labeled as notes payable, or things labeled as the current portion of long-term debt. So those are operating liabilities. And so in order to calculate total operating capital in any given year, we take those operating assets, which is all assets except for short-term investments, and subtract off this handful of short-term liabilities. And the investment in total operating capital in a given year is simply the change in total operating capital from one year to the next. The total operating capital in the current year minus the total operating capital in the previous year. And again, you can think of it as the amount of money that you have to plow back into the company in a given year in order to grow the asset base enough to support your current year's operating plan. So it's the amount that you have to reinvest into the company. So let's go ahead and calculate free cash flow in our example. So here's a company. It's got $32 billion in sales in the current year, and we've actually projected their financial statements, actually complete financial statements, out for 6 years. And what we want to do is calculate the projected free cash flow in each one of those 6 years of projections. And in order to do that, we need to calculate NOPAT, and then we need to calculate total operating capital, and then we need to calculate the investment in total operating capital, and NOPAT minus the investment in total operating capital is equal to free cash flow. And so let's go ahead and do NOPAT first. NOPAT is simply EBIT, or in this case it's called operating profit. Sometimes it's called EBIT, sometimes it's called operating profit. And by the way, do not confuse EBIT with EBT. That I really does matter. EBT, earnings before taxes, sometimes called profit before taxes, is not the same thing as EBIT, earnings before interest and taxes. So we start off with operating profit, or EBIT, and we multiply it by, look up here, 1 minus the tax rate. And in our case, the tax rate, for simplicity, we're going to assume that it's constant, and that's not too bad an assumption. So the EBIT times 1 minus the tax rate. And that's what we're going to have in every year. We'll do copying this out for 6 years in just a second. Now, total operating capital, we need that for the previous year so that we can calculate the change in that first year projections. And so total operating capital is, we decided it was total assets less short-term investments, and so it will be our total assets. So I need an equal sign. Total assets minus our short-term investments. And then from that, we subtract off, and that would be our operating assets. And from that, we subtract off accounts payable, and we subtract off accruals, and we subtract off other operating current liabilities, but we do not subtract off short-term debt. We do not subtract off current portion of long-term debt. We do not subtract off notes payable, because notes payable is another word for short-term debt. And that gives us total operating capital in our most recent year, the year that's already happened. That gives us $36 billion in last year, $37 billion in the current year, and that means our investment in total operating capital is this year's minus last year's, which is $1.454 billion. And so our free cash flow in the first year of projections is our NOPAT minus the $1.454 billion investment in operating capital. And that gives you $3.618 billion in free cash flow. And we can now just copy that all the way out to the end of the year, end of the projected years. And then let's go back to our slides. All right, now that we're back at the slides, what I want you to do is open up your Excel spreadsheet and you calculate free cash flow for your company. Pause the playback, calculate the free cash flow for your sample company, and then resume the playback when you're done. All right, so welcome back to the slides. Let's talk about the corporate valuation model for just a minute. The corporate valuation model takes the value of a firm's operations to be the present value of all of its expected future free cash flows. And if you think about it, the free cash flows that a firm generates, those are the things that it does through its normal day-to-day operations. The present value of all of that is the value of the entire firm. It's the value of the stock, it's the value of the debt, it's the value of any preferred stock. It's the operating component of the firm. And what we do to calculate the total value of the firm is we take that value of operations, we add in the non-operating assets, the things that are not going on as a day-to-day activity. So for example, if some firms have billions and billions of dollars of marketable securities that are not involved in their day-to-day operations, those are separate. Those are not contributing to free cash flow. So we add in the value of those non-operating assets, and for most companies, that's short-term investments or line items that look like that. Subtract all debt and preferred stock, if there is any preferred stock, and the result gives you the intrinsic value of equity. It's actually a pretty simple little equation there, and this is written down in equation form. The value of operations is the present value of all of the free cash flows discounted at the weighted average cost of capital. We add in short-term investments. This gives us the total intrinsic value of the firm. Subtract off any preferred stock, subtract off any debt, and these are market values if you can get them. That gives you the intrinsic value of the stock divided by the number of shares outstanding, and that gives you the price, the intrinsic value per share, or the intrinsic price per share. And so our steps, and we've already done the first three: calculate the weighted average cost of capital at the firm's target capital structure, project the operating components of the financial statements until that firm reaches a steady state growth period. And you can't do this valuation model if you don't project the company's financial statements all the way out until it reaches a steady state perpetual growth. And that growth rate has to be less than the weighted average cost of capital. If your company is growing faster than the weighted average cost of capital, if G is bigger than that, then you just have to keep on projecting it out until it won't. So keep on projecting. That might be 20 years, but you need to project out until the growth rate is less than the WACC. From that, calculate the free cash flows from those projected financial statements. We've done that. And then here's what we're going to do right now is we're going to calculate a horizon value of those free cash flows. We're going to discount the free cash flows and that horizon value to get the value of operations. We're going to add in non-operating assets, subtract off debt and preferred stock to get the intrinsic value of the equity. And to use this model reliably, you need a situation where the company is maintaining a constant capital structure. That's what the corporate valuation is really good for. And so let's do that for our company first. All right, so what we're going to do is we're going to use the corporate valuation model with the free cash flows that we've already calculated. So the first thing we need to do is, what we're ultimately going to do is we're going to look at these free cash flows, 3.6, 3.7, 3.9, 4.1, 4.3, and $4.5 billion. We're going to calculate a horizon value. So these free cash flows are going to continue to grow forever, and we've assumed that they're going to continue to grow forever at a 4% growth rate. That means that we need to calculate the present value of all of those infinite extra free cash flows back to, in this case, times 6. And so that's just going to be our free cash flow in year 6 multiplied by 1 plus the growth rate. That'll give us the free cash flow in year 7. And we need to divide it by the weighted average cost of capital minus the growth rate. In this case, I've assumed that our weighted average cost of capital is 8%, and our growth rate is 4%. And so if you look at the formula up here, we've got our last year's projected free cash flow grown up by 1 period at the growth rate divided by WACC minus G, and that gives us a horizon value of $118 billion. That's quite a bit. And our value of operations, meaning the present value of all of the free cash flows, will be the present values of these 6 free cash flows and this 7th horizon value. Now, the easiest way to do that is with the NPV function, where we put in a discount rate. That would be our weighted average cost of capital. And then we have 1, 2, 3, 4, 5 values. And then we have a 6th value. And then add to that 6th value the horizon value, which is also in year 6. And notice that last item is the 6th free cash flow and the 6th year horizon value. So those are at the same location within the NPV function. And so they both get discounted 6 periods. So the NPV function starts off with a discount rate, and then cash flow 1 up to, in this case, we're only go to 5. Then we'll use 6 separately because we want to add in the $118,299 and have that discounted 6 periods as well, 6 years as well. And that gives us $93 billion. We're going to add in, so let's point to short-term investments, which in this case is only $2 billion, not a ton of short-term investments. That gives us the total intrinsic value of the firm of $95 billion. Debt, and we want all debt, so we want the short-term debt, and we want any long-term debt, and we'll come back and talk about this long-term debt in just a minute. Long-term debt, and subtract the $95 billion, subtract from that the $21 billion in debt, and that gives us $74 billion intrinsic value of equity. If we want to know how much that is on a per share basis, we have $74 billion divided by the 575 million shares. Make sure everything's in the same units. So 74,167, 74 billion, that's 74,167 million. And so this is in millions right here. This is in millions. You can actually do the division, and that gives us $128.99 as the intrinsic value per share for the stock using the corporate valuation model. Note, however, and this is really important, note that the corporate valuation model assumes that the capital structure is constant. However, I've set up this company so that it's going to have a major restructuring. In other words, somebody's going to, this year 0 is the way it looks right now. It's got $18 billion in debt. Somebody is going to ramp up the debt substantially. They're going to borrow a whole ton of money and then use that money. They're going to acquire it. And so they're going to use that money to pay themselves back and reduce their equity position. And that means they're going to jack up their debt and then pay down that debt over the next 7 or 8 years. And they're only going to pay down some of it because actually some of it's going to get swapped into short-term debt as well. But in any case, this change in capital structure means that the corporate valuation model really isn't the appropriate model to use for valuation. And so let's go back to the slides and talk about that. All right, so in this case, the corporate valuation model wasn't actually the best model that we could use. And after you apply the corporate valuation model to your example, then we will move into the adjusted present value model, which will be a more appropriate model for this valuation. So what I want you to do is I want you to pause the playback, and I want you to go through the steps on your company as well, which is to calculate the intrinsic per share value of your company using the corporate valuation model. You might want to pause and then back up a little bit to see how I did it, but I want you to implement that into your model, and then start the playback again as soon as you're done. All right, welcome back. I hope you were successful calculating the intrinsic value per share of your company using the corporate valuation model. And you'll notice if you looked at the debt for your company, that company was also set up to have a major restructuring in the first year of projections. And so the company's debt increased substantially in that first year, and then it played it down some over time as the company paid back some of that debt. So they changed dramatically. The corporate valuation model was not really the appropriate model for this. And so really those numbers that you get, although they aren't too bad for ballpark numbers, are not quite as accurate as you would like. It's easy enough to use the APV model, so you ought to. Now, the APV model is like the corporate valuation model in the sense that it does value the entire firm. The corporate valuation model valued the firm's operations. The APV model also values the firm's operations. However, the APV model does allow for time-varying capital structure, which the corporate valuation model does not. It values the interest tax shield separately from free cash flow, and that's not what the corporate valuation model does. And operationally, what it does is it discounts the free cash flows and the tax shields at, we've got RU, which is called the unlevered cost of equity, which is not the same thing as the weighted average cost of capital. So it uses a different discount rate, RU, than does the corporate valuation model, which uses the weighted average cost of capital. So there are some significant differences as well, although the programming in Excel looks actually pretty straightforward. It only requires a couple of extra steps to do the APV model. So the APV model steps, and again, many of these are like, but not exactly the same as the steps in the corporate valuation model. First, you have to project financial statements. And in this case, you actually have to project complete financial statements. With the corporate valuation model, you can get by just projecting the operating components of the financial statements, and that would be most of the asset side of the balance sheet, the income statement up through EBIT, and only the short-term part of the liability side of the balance sheet. But for the APV model, we actually need debt because we need to know the debt levels and we need to know the interest expense in order to explicitly calculate the interest tax shield. So you need completed financial statements, not just partial financial statements. From those completed financial statements, we calculate free cash flows, and we're going to actually use the free cash flows we calculated for the corporate valuation model. You also need to project the debt levels, and you pull those actually from your completed financial statements. Calculate the interest tax shields. I'll explain that in just a minute. Discount those free cash flows at the unlevered cost of equity. I'll explain how we do that calculation as well. Discount the interest tax shields at also this unlevered cost of equity. Add together both the free cash flows, present value of the free cash flows, and the tax shields, and that gives you the levered value of the firm's operations. And as a matter of fact, this line is the equivalent of, it's not the same number as, but it's the same concept as the value of operations that you get in the corporate valuation model when you discount free cash flows at the weighted average cost of capital. So we have more steps to get to this line item because we've got free cash flows and tax shields discounted separately. Then we just do the same thing we'd have done with the corporate valuation model, which is to add in non-operating assets, subtract off debt and preferred stock, and that will give us the intrinsic value of equity. So one thing to note is we have to calculate the unlevered required return on equity. So RU, that's a number that we need to calculate. It's not something that's readily observable, and we have to do some work for it. Now, when we were discussing capital structure before, we discussed something called the Hamada equation. And if you're looking at this and we haven't discussed it yet, the Hamada equation was an old-fashioned way to lever and unlever betas. When a company has more debt, then the beta is bigger and it's riskier. When a company has less debt, the beta is safer, and the unlevered beta is the beta the company would have if it had no debt. Well, this formula that Hamada used had a beta U, and a 1 minus the tax rate, and then the debt over stock, or WD over WS, the debt equity ratio. We're going to use a slightly different one that is for technical reasons a better measure of unlevered betas, and those technical reasons involve whether or not the firm can have growth and also the appropriate discount rate for the tax shields. We're not going to go into the theory for that, You just have to take my word for it that the unlevered beta, well, first off, the levered beta formula is that if you have a company that has no debt and you observe its beta, and then you want to observe what the company's beta is going to look like after you add some debt, then you take its unlevered beta, the one that where it had no debt, and it's beta u plus beta u minus beta d. On the next slide, I'll show you what the beta for the debt is, times the debt equity ratio. And what we really are going to care about is the unlevered beta. And so you can solve that equation backwards to get beta u, which is this little expression right here. But important to note is there's no 1 minus t factor. And the reason there's no 1 minus t factor is that we're going to explicitly incorporate the tax shields and not have those tax shields incorporated in the discount rate. And why is that? Well, that's because those tax shields are changing every year. So the way that we calculate RU is we're going to use beta u in the capital asset pricing model, and what we need is a BD, a beta for the debt. And what we do is we just treat debt as if it were a stock. In other words, we just treat the required return on debt and pretend like it's a stock and just solve the capital asset pricing model backwards in order to get the beta for that debt. So if you observe a stock's, a bond's required return, or the required return on debt for a company, and we pretend like the capital asset pricing model applied to it, we would say that that return is the risk-free rate plus whatever its beta was multiplied by the market risk premium. Well, we can solve this little equation for beta d, and if we do, we see that beta d is the required return or expected return, yield to maturity, minus the risk-free rate divided by the market risk premium. So it's easy enough to plug in there. Now, there's also a shortcut that we can use, and we'll do this both ways. There's a shortcut that we could use, and that shortcut is really actually a really good, easy shortcut, is we can go directly to the required return, the unlevered required return on the stock, and that is simply, if you work it all out, just the observed weight on debt times the observed required return on debt plus the observed weight on stock times the observed required return on stock, where this observed required return on stock generally comes from the capital asset pricing model, but it doesn't have to. It's whatever model it is you're using for observing the required return on stock. And again, it does not have a 1 minus t in it. As a matter of fact, this looks just like the weighted average cost of capital formula without the 1 minus t in it. So what we're going to do is we're going to go to Excel and calculate RU ourselves, and then I'm going to have you do it. So let's calculate the unlevered required return on equity for our company. So here are the free cash flows in the corporate valuation model that we've already worked on. And now here's some data for calculating the unlevered required return. We observed a beta of 1.2 for this company, and that beta corresponded to a capital structure that the company had, which was 80% stock and 20% debt. We observed that its required return on debt, its yield to maturity on its debt, was 5%, the market risk premium was 5.5%, and the risk-free rate was 2.5%. And so what we can do with this information is we can calculate the unlevered cost of equity, and there are two different ways. I'll show you both of these calculations, but let's look at the easy one first. The easy one is simply to take the weight on debt, multiply it by the required return on debt, take the weight on stock, multiply it by the required return on the stock. And so in order to do that, first thing we need to know is, using the capital asset pricing model, what is the required return on the stock? And you remember from the capital asset pricing model that the required return on stock is the risk-free rate plus beta times the market risk premium. And in this case, we've got the risk-free rate plus beta times the market risk premium, and that gives us the levered required return on the stock. And when I say levered, that's because we already have 20% debt in the capital structure. It's a levered required return. We want the unlevered one. And so if we take the unlevered required return, and to calculate the unlevered required return, we take the weight on debt multiply it by the required return on the debt, the 5%, add to it the weight on stock, the weight on equity, multiply it by the levered required return that we just calculated, and that gives us an unlevered required return on equity of 8.28%. That's the easy way to do the calculation, and frankly, I think you probably ought to do it that way. On the other hand, the theory also says that betas are going up and down as a result of changing in leverage, and so it makes some sense at least to look briefly at what happens if we run all the way through the beta calculation. And so remember that the complicated formula solved for beta u is equal to, if you take that beta u formula from the slides and beta L formula from the slides and solve for beta u, we see that beta u is beta L, the levered beta, the observed beta, plus beta of the debt multiplied by the debt equity ratio, all divided by 1 plus the debt equity ratio. And that's kind of a complicated little formula, but it's easy enough to implement into Excel. So we need to know, first off, the debt's beta. And the debt's beta is easy enough to calculate by solving the capital asset pricing model backwards, which is to take its required return, which is 5%, subtract off the risk-free rate, 2.5%, and then divide the whole thing by the market risk premium, and that gives us 0.4545. In other words, this low rate of return is like the rate of return that you'd expect on a stock with a really low beta. That's the beta on the debt, and then we use this fairly complicated formula to get a new unlevered beta. And then we use the capital asset pricing model to take that unlevered beta and turn it into a required return. So we have the risk-free rate, 2.5%, plus the new unlevered beta multiplied by the market risk premium. And sure enough, we get the same answer either way. Well, these calculations are long and involved. These calculations are actually pretty simple. And so if you're trying to implement this, go ahead and implement it this way. And when I ask you to do it on your company, go ahead and just do it this way. All right, so this is our unlevered cost of equity, 8.28%. So 8.28%. Now I want you to pause the playback and calculate the unlevered required return for your stock. All right, welcome back. I hope you calculated the unlevered required return for your stock as well, and notice that it will be less than the levered required return. All right, so now let's talk about interest tax shields. Now that we've got a discount rate to use for free cash flows and a discount rate to use for the interest tax shields, let's talk a little bit about them. So you've projected complete balancing financial statements. In other words, we have projected, the ones that we're using, are financial statements that have specifically what type of financing we're expecting to use every year. That information is not needed for the weighted average cost for the corporate valuation model, but it is needed for the adjusted present value model because we need the tax shield. So the interest tax shield, and sometimes I'll just abbreviate that as tax shield. The interest tax shield is equal to the interest expense multiplied by the tax rate. That's all you have to do is calculate interest expense multiplied by the tax rate. And since our financial statements are complete, we actually have a line item that has interest expense. Now, one thing you want to make sure you're using is do not use what shows up frequently in financial statements as net interest expense. Frequently, financial statements don't have a separate line item for interest income and a separate line item for interest expense. They actually net one against the other, and so they'll call it net interest expense, and it'll be interest expense minus any interest income that you've earned, so it's your net position. That is not what you want. For our tax shield, we want the tax shield from all of the interest expense that's paid to debt holders. In our financial statements, we have them separated, interest expense and interest income, and that's important. If you don't have them separated, then you're going to have to calculate the interest expense on the debt level from the projected financial statements themselves. So in our case, we do have it. So if you only have those projected operating components, which is all you need for a corporate valuation model analysis, you're going to still have to project out debt. in order to get the interest expense from that. So you've got to have completed financial statements, not just the operating components. And so what we're going to do here is we're going to calculate the interest tax shields and the horizon value of those tax shields and the present value of all of those tax shields at the unlevered cost of equity. So back to our company. Let's observe interest expense, and we know that our projected financial statements already have interest expense on the income statement. Notice we've got interest expense here. We've also got a separate line item for interest income, so this is not net interest expense, it's just interest expense. So we're going to keep that, so we have that line item for us to look at. We're going to calculate the interest tax shield, which is our interest expense multiplied by the tax rate, because where is my tax rate? Multiplied by the tax rate, because that's the amount of taxes that you save by having interest expense, by charging off interest expense. And I'm putting some dollar signs in here because I'm going to be copying that out. And we also have, and I'm just going to record this from above, we need the free cash flow. We don't have to do a separate calculation for free cash flow. That's already there from the corporate valuation model. And so I'm going to copy all this out. This will give us interest expense, interest tax shield, and free cash flow out for the 6 years of projections. And what I want is, the first thing I want is the horizon value of this interest tax shield. So we've got $425 million interest tax shield. $425 million interest tax shield. We want to know what the present value of all of that growing at 4% is at the discount rate, which is the unlevered cost of equity. And so we're going to take the last year's projected interest tax shield. We're going to gross it up by 1 year's worth of growth, and we've still got that 4% long-term growth rate. And then we're going to divide it by the unlevered cost of equity, which is now replacing our weighted average cost of capital in our valuation formula, minus the growth rate. Let's look at this. That gives us the 6 years interest tax shield grossed up one period, so times 1 plus the growth rate to get the 7th year's interest tax shield, divided by R minus G. In this case, R is the unlevered cost of equity, and that means that the present value of all of those interest tax shields are pretty doggone significant, $10 billion. So as of year 6, all of those interest tax shields are worth $10 billion in value for the company. And if we want the value today of all of that, we can use the NPV function with, again, our unlevered cost of equity rate. And we want all of our interest tax shields. So 1 through 5, we're going to do just like we did before. We're going to add in the 6th one plus the horizon value. And it turns out that the value of all of these interest tax shields, when you add them all together at the discount rate of 8.28%, is $8.3 billion. That's a lot of value. That works out to a lot of money all of a sudden. So $8.3 billion is pretty significant, and that's the present value of all of the interest tax shields. So now I want you to do this for your company. Pause the playback and calculate the interest tax shields, and then the horizon value of those tax shields, and then the present value of all of them, all at the unlevered cost, all at your unlevered cost of equity. Welcome back. Now let's do the deal with the free cash flows. So in order to deal with the free cash flows, we're going to do the same thing that we did with the corporate valuation model. We're going to calculate a horizon value of those free cash flows, but we're going to do it at the unlevered cost of equity. Then we're going to find the present value of all of those free cash flows and the horizon value. And this result is going to be called the unlevered value of operations. Now, when we did this with the corporate valuation model, we included the tax shields in the weighted average cost of capital. And that end result at that point was just the value of operations in total. But with the APV model, we need to do first this, and then we need to add to this present value of the free cash flows the value of the tax shields that we just generated just a minute ago. And so what we're going to do is after that, we're going to add in non-operating assets, and that's going to give us the intrinsic total value of the firm. Then we're going to subtract off debt, and that will give us the intrinsic value of equity, and then we'll divide by shares outstanding, all of which are exactly the same as we did in the corporate valuation model. And so let's do that for our company right now. So over on this Excel spreadsheet, we've already calculated the present value of all of the interest tax shields. Now let's do the same thing for the free cash flows. So we need to calculate the horizon value of all of our free cash flows. And the way we do that is we take the last free cash flow, grow it up by one period at the growth rate, in this case 4%. And we divide it by, in this case, not WACC, but rather the unlevered cost of equity minus that growth rate. So there's our horizon value calculation. And it looks like I have missed a formula here. I need a slash and not a question mark. So that gives us let's look and make sure we've got everything the way it ought to be. That gives us the last free cash flow, grossed up one period, so times 1 plus the growth rate divided by R minus the growth rate, and that gives us a horizon value of $110 billion. And notice the interesting thing is that the horizon value of the tax shields is pretty doggone big. It's 10% of the horizon value of that firm's unlevered operations. So those tax shields do contribute a significant amount of value to the company. All right, so now next we want the unlevered value of operations, which is going to be the present value of all of the free cash flows and the present value of that horizon value. So it's going to be all of these free cash flows and this horizon value, and we'll do the same formula that we did both for the tax shields and the free cash flows in the corporate valuation model. The net present value function, our interest rate is the unlevered cost of equity. We're going to highlight years 1, 2, 3, 4, and 5, and then take year 6 separately plus the horizon value at year 6. And that should give us the present value of the firm's free cash flows at the unlevered cost of equity. And that end result, when I press enter, is going to be called the unlevered value of operations. This is the value of operations that the firm would have if it had no debt. So if this firm had no debt, its value of operations would be $87 billion. But since it has debt, the value of operations is actually 8.3, almost $8.4 billion larger because of those tax shields. And so our total levered value of operations is the tax shields and the unlevered value of operations. So the benefit from the interest deductions. We're going to keep track of short-term investments because we're going to add that in. That gives us the total levered value of the firm. So $97 billion is the total levered value of the firm. $95 billion of it is from its operations. $87 billion of it is from its operations. $8.4 billion of it is from interest tax shields. That is the value of all the taxes that you don't pay the government because you are deducting your interest payments. We're going to subtract off all debt. And it's all debt now, not all debt after the recapitalization. So we're going to subtract off, we want long-term debt and we also want short-term debt. So $18 billion worth of long-term debt, $3 billion worth of short-term debt, just like before. The intrinsic value of equity is 97 minus 21, or $76 billion. And on a per-share basis, that's 76 divided by our 575 million shares, which is 132.94. Now notice you get different answers using the corporate valuation model and the APV model. Well, that's because they have different assumptions underlying them. And frequently the difference is more than what we have right here. This difference of 128 versus 132 is not all that significant. Frequently, it's actually more than that. The APV model is the one that is appropriate in this case because, and let's go ahead and look at the debt here and see what's going on, because this firm is moving from $18 billion of debt, roughly 20% of its value, up to $50 billion in debt, which is, I forget, 40 or 50% of its value. I forget what percentage it is that I put into the calculations, but it's more than doubled its debt. It's almost tripled its debt, and so that means that its capital structure was not constant during that time period, and and so you can't use a constant weighted average cost of capital, and you can't reliably use the corporate valuation model. So these time varying debt levels, and notice the long-term debt is going down, but the short-term debt's coming up a little bit. And you also might ask, what in the world did they do with all of this money? Let's just go ahead and address that question real quickly. What did this particular company do, or what are we projecting that it's going to do when it recapitalizes with all of this debt? Well, there are two things that it could have done. Maybe there's more than two things that it could have done. It borrowed this whole ton of money, and it could have paid it all out as a dividend. And that would have been an okay thing to do, but probably the company, the venture capitalist or the private equity firm that's buying this company would not want to receive all of that money as a dividend, because then they'd have to pay tax on it, and that's not what they want to do. And so what they have done is that they have taken all of this cash that they generated, and they have used it to repurchase shares. And so when it went from $18 billion to $50 billion, that's an increase of about $30 billion, which means they had $30 billion in cash, at least briefly. They used that $30 billion in cash to repurchase stock. And notice this line item here, par plus paid in capital less treasury. When you subtract off the treasury stock, it becomes a big, huge negative number, which is the $32,362 million that they essentially used to repurchase stocks. And what that leaves is a negative total common equity figure. And that's not a bad thing. That negative total common equity figure is not a bad thing. It just means that the company was so profitable that it was able to borrow money or generate enough cash flow to buy back a whole ton of stock. And when it buys back a whole ton of stock at a high price, that gives you a negative common equity figure. It's not a bad thing. And as a matter of fact, this is another indication of why book value of equity is such a terrible measure of value. Because look, these big old negative numbers, nothing wrong with this company, but they don't convey anything useful in terms of value. The company is not worth negative $18 billion here. As a matter of fact, the company is worth something on the order of, what do we figure out? The company was worth $74 billion, not negative $18 billion, or actually we came up with $76 billion here with the APV model. So book value of equity, terrible measure of value, especially when you have repurchases. And you shouldn't use it for measuring value. But notice it is a big negative number, and that's not unusual. That's exactly what you would expect when a company does a major recapitalization with a share repurchase. So let's move over back to the slides. So back at the slides, let's let you do this. So what I want you to do is I want you to pause this presentation. I want you to calculate the horizon value of the tax shields, the present value of those tax shields, the horizon value of the free cash flows, present value of the free cash flows, add in short-term investments, subtract off debt, and divide by shares outstanding to get the intrinsic value of equity using the APV model for your company. And then come back when you have done that. All right, welcome back. And so now what you have is a single spreadsheet that has both the corporate valuation model and the adjusted present value model on it. It shows you the difference in calculations. It shows you specifically what you have to do for one versus the other and the inputs that you need. And one thing to note, and I've said this before and I'll say it one more time, you're not going to get the same answer with the corporate valuation model that you get with the APV model, and that's because they do have different assumptions embedded in them. And specifically, and this is important that you remember this, the corporate valuation model assumes that debt as a percentage of market value is constant, that the capital structure is constant, but the APV model allows debt to be anything. And that means that you can use the APV model in all sorts of much more interesting scenarios than you can in the corporate valuation model. So some of those interesting scenarios might be leverage buyouts, management buyouts, equity restructurings. You can have something where you lever the company up and then sell off pieces of it over time. You could have a situation actually where you buy an over-levered company and pay off the debt because maybe it's because it's almost getting ready to go bankrupt because it's suffering financial distress from all of its debt, and lever it back down. All of those are interesting situations, and they can't be addressed just with the corporate valuation model. All right, that's it.